What if you put $1,000 into IBRX today? Could it double? Could it 5x? Or could it get crushed? Let's break this down the smart way. No hype, no fantasy math, just realistic scenarios and compound growth logic. IBRX, ImmunityBio, is a biotech company focused on cancer immunotherapy. And biotech stocks, they don't move slow. They either explode or disappoint hard. So let's assume you invest $1,000 at around $5 per share. That gives you roughly 200 shares. Always check the current price before investing. Now we'll walk through 3 realistic paths. First, the bear case. Biotech is risky. Clinical trials can fail. Approvals can get delayed. Companies can dilute shareholders by issuing more shares to raise cash. If IBRX delivers a negative 10% average annual return for 5 years, your $1,000 compounds down to around $590. That's the downside nobody talks about, and it's real. Now let's move to the base case. Let's say the company executes decently. Revenue grows. No massive breakout, but steady progress. Maybe institutional investors slowly start building positions. If the stock compounds at 20% annually for 5 years, your $1,000 becomes about $2,488. That's more than double. Solid, but not crazy. Now here's where things get interesting. The bull case. Let's say approvals hit. Revenue ramps fast. The market re-rates the stock. Momentum kicks in. If IBRX compounds at 40% annually for 5 years, your $1,000 becomes about $5,378. Now imagine a stronger breakout cycle. 60% annual growth. That turns $1,000 into over $10,000. Sounds crazy? It's rare, but in biotech cycles, it happens. But here's the key. For that to happen, execution must be strong. Cash burn must be controlled. Revenue must scale. And the biotech sector overall must cooperate. In part 2, we're going deeper. We'll talk about whether this is actually realistic, what risks you need to watch, and whether this is a smart move or just speculation. All right, now let's get real. Is a 5x or 10x in 5 years actually realistic for IBRX? Here's what needs to happen. First, revenue growth must be visible and consistent. If revenue stays weak or unpredictable, the stock won't sustain big gains. Second, cash runway matters. Biotech companies burn cash. If they keep issuing new shares, your ownership gets diluted. That limits upside. Third, institutional interest. When hedge funds and big money step in, that's usually when serious momentum builds. Fourth, sector strength. When biotech runs as a group, small cap names can move violently. Now let's talk risk. This is not a safe dividend stock. This is not a slow index fund. This is high risk, high reward territory. You should never put money into a biotech stock that you can't afford to leave untouched for years, because volatility will test you. There will be 20% drops, maybe 30% swings. Headlines that scare retail investors out. The winners in biotech are usually the ones who understand the thesis and don't panic. Now here's my balanced take. IBRX has asymmetric upside potential, meaning limited downside to zero, but potentially large upside if things go right. But probability matters more than dreams. If your goal is stability, this may not be for you. If your goal is calculated risk with possible explosive upside, and you size your position properly, then it can make sense as part of a diversified portfolio. And remember, this is not financial advice. This is for educational purposes only. Always do your own research. So now I want to ask you, are you bullish on IBRX long-term, or are you staying cautious? Drop your view in the comments, because in the market, patience beats hype every single time.